Since dividend investing went mainstream, investors have sought dependable income. But what exactly is dividend investing? How do we spend and maximize dividend stocks? Dividend investing includes carefully buying dividend-paying stocks to develop wealth, income, and financial stability. Today, we share some rules on how to reduce risk with dividend investments. Let's start! Number 1. Know your goals. The first and probably most important rule for dividend investors is to know who they are and where they want to go. You should believe in the dividend investment plan and stick with it for the long term, or you won't get the benefits. Set short-term goals like earning $500 a year from dividends, and then set long-term goals like using earnings to pay off your monthly bills. Many income investors want to be able to live off of dividends alone. This is hard for many people to do and takes a lot of money and time, but it is possible. In short, write down your financial goals, make a detailed plan for how to reach them, and then follow that plan. Number 2. Maintain your modesty. Have you calculated potential dividend returns if they were to be cut during a recession? When dividends continue to grow at a rapid pace from year to year, especially in light of the most recent 10-year bull market run, it is easy for a dividend investor to become smug about their financial condition. If the stock market falls by 30% the next day, investors must consider how confident they are in the returns on their dividend investments. In particular, consider which dividend companies are more likely to lower payouts and how your dividend return would alter if payouts were reduced during a recession, which is entirely possible. Because you cannot predict the performance of every asset, you must avoid becoming unduly tied to the money you have invested in the past. Always be open to new ideas and proposals, and always keep an eye out for unanticipated market opportunities. Number 3. Find dividend-paying companies. A dividend-paying company is an important aspect to search for in a dividend stock to minimize investment losses. This is because it illustrates that the company can maintain its payment even if the market falls in the short term. When investors believe a company's dividend payments cannot be sustained, they lower the stock price and prepare for a decrease. When there is a cut, the stock will eventually continue to fall as investors flee. Furthermore, most significant investors, such as investment funds, would reduce or even sell their entire holdings if the company did not pay dividends. Check the percentage of the company's profit that is used to pay dividends to select firms with good dividend stocks. If the company pays less than half of its profit in dividends, there is a better chance that it will continue to pay, even if the economy suffers a short-term downturn. Number 4. Avoid ignoring low dividend stocks. Discover the surprising power of low dividend stocks for long-term investors. If everything else is the same, a starting dividend yield between 3 to 5% is better than a starting dividend yield between 2 to 3%. This is because you will get more value for your money. But if you own these lower yield income stocks, you may have a good chance of getting a high yield on cost, YOC, 10 or 20 years from now. One company that does this is 3M. So if you're just starting out or have a small investment budget, it may be smart to put some of your income portfolio into stocks with yields below 3%. Even though you should usually stick with starting yields above 3%. If you do this, make sure it meets all the other conditions for an investment that pays dividends. Number 5. Diversify your portfolio. Diversifying your stock portfolio is equivalent to saying, don't put all your eggs in one basket. This is done so that you can manage your investments effectively and keep your future dividend payments from declining during a market downturn. Diversifying your holdings with dividend equities such as the Coca-Cola Company, JP Morgan Chase & Co., Verizon Communications Inc., or Cisco Systems Inc. reduces risk and safeguards your passive income. Thus, if returns in one area fall, other equities will perform well, mitigating the loss. Look over your list of potential firms with reliable yields and wait for the optimal time to acquire them to learn how to develop a dividend portfolio. Also, avoid yield traps by checking before purchasing dividend stocks on credit. High yields are meaningless if they cannot be maintained. Number 6. Expect the unexpected. You should constantly be aware of the dangers you are incurring as an investor. In short, life happens and the stock market makes no sense. As a result, make sure you have an emergency fund to preserve your dividend investments. The last thing you want to do is sell an income investment that is rapidly increasing in value. You should also have a healthy mix of income equities, an emergency fund, and investments that are not dividend stocks. This includes investing in dividend-paying firms based on their company and dividend yields, among other things. If you do this correctly, you will secure your dividends and future growth, and you will not lose as much in dividends from volatile industries like technology, retail, and oil. Number 7. Maintain your discipline and patience. To build a dividend-generating portfolio, you must be patient and disciplined over time. Have you discovered any excellent dividend-paying companies? Invest early and continuously reinvest dividends. Emotions make it tough to maintain wealth management discipline. Stay the course during stock downtimes and avoid superfluous factors. Diversification is also beneficial. There may be surefire high-return investment opportunities, but buying and keeping dividend stocks will protect you in the long run. Berkshire purchased 400 million shares of a beverage company for $1.3 billion, adopting Warren Buffett's buy and hold strategy. The stock is valued at $25 billion as of June 2022 and will pay Berkshire $700 million this year after nearly 3 decades. From 1977 through 1990, Peter Lynch managed the Fidelity Magellan Fund, raising its assets from $18 million to $14 billion. Number 8. Take dividend growth seriously. Before investing in a dividend-paying stock, check to verify if the firm has consistently increased its dividend. Success depends on dividend growth. A corporation that pays the same dividend each year may not be growing or dominating its industry. A flat dividend should be a significant red flag for dividend investors and may indicate a dividend decrease. Investors can reinvest dividends to increase compound interest and obtain bigger payouts with dividend growth. Rising dividends equals higher income plus stock price. Companies that continually increase their dividends usually see stock price increases. Many companies that follow the dividend growth concept see their value rise as their dividends rise. Naturally, more people will invest in dividend-growing companies with a track record. Number 9. Accept bad dividend investments. Even if you thoroughly evaluate every dividend stock you add to your dividend portfolio, as your dividend portfolio grows and you must choose lower quality stocks, you will almost certainly have multiple dividend firms that cut or reduce their payout. Whether you acquired it for the income or the capital appreciation years ago, this stock was a horrible investment. To save money, KHC cut its dividend by 36% at the start of 2019. Investing in Kraft Heinz is a bad idea, but dividend investing is a good long-term investment plan. Because dividend investors should be well diversified and own numerous dividend equities, a single poor investment will not have a significant impact on their income. Diversification will counter losses in your dividend portfolio with winners. You should also keep in mind that most dividend equities do not experience the same price and dividend declines as Kraft Heinz. Despite the negative outlook, dividend investors need to know when to sell dividend investments to avoid more losses. Number 10. Be patient. Warren Buffett says, "My favorite holding period is forever." With their competitive advantages, reputable companies can multiply your wealth over time if you invest patiently. A $1,000 Coca-Cola investment made 25 years ago is now $14,900. This method is tax-advantaged. A qualified tax planner will tell you that selling a stock in a taxable account will result in capital gains taxes. If you don't sell, dividend reinvestment is tax-free and your money compounds. Letting stocks go minimizes portfolio turnover. Lower frictional costs such as brokerage, transaction expenses, slippage, etc. mean more money to invest. Research blue-chip dividend stocks and invest consistently. Diversify your portfolio, control your emotions, and save generously for emergencies. These will protect your portfolio and keep your hands out of your cookie jar. These dividend investing rules will greatly boost your portfolio. While it takes discipline and patience, investing can lead to retirement and financial freedom. If you like this video, click below to subscribe for more videos like this. See you next time!